Hello and welcome to this video. I welcome you to this video of Investing Mastery Series, and today's topic is all about risk rewards. So we have been learning some investing concepts in the last first days. We started with why investing, and in yesterday's video we discussed a lot of important things like power of compounding and how to use it. So let's get going. Okay, before that I need your comment. Today I'm recording the very first video from this new mic. For better audio quality and to give you some better experience, I have just purchased this mic today. So do let me know how is the audio. Is it better or how do you feel? Just do let me know in the chat box and let's continue further. So today's topic that we're going to discuss is risk reward concept. A very important concept in your investing journey, which is something that if you don't learn, you cannot make your way forward in the investing journey. So how does risk reward affect your investing journey and what are the things that you need to keep in mind? So risk and reward in any investment opportunity will always be proportional. Now this is very important. Like, as I've told in my earlier videos as well, that Indian investors and Indian traders are particularly so avid about returns, rewards. They're like, okay, they want good return, they want high return, high return, high return. But my dear, you got to keep in mind, you got to understand that high return always, let me say always, brings along with it high risk. It goes without any exception in the world. Like, okay, let me keep it simple for you guys. Let's not talk about investment. Let's not talk about equities and all that. Simply, if I can talk about, if you do job, let's say you're doing a job, it's relatively safer. Do you agree with me? Like you get a fixed monthly salary. You don't have to worry about whether company is growing, company sales, what is happening and all that. You will get your fixed salary. But at the same point of time, there is a lesser risk, but there is a lesser reward. Like if your company is growing crazily, sales are just booming like crazy, still you will get the same fixed salary. Whereas if you are a businessman, if you're an entrepreneur, you bear the high risk. You might have to burn your own money. If the business is not doing good, you are the one who has to sacrifice a lot. But if that risk, you are ready to take that risk, when rewards come, when return come, you also bear the fruits, right? So same thing applies in investing as well. Always risk and reward are proportional in any field of life. This is a very important concept. So instrument with high underlying risk like equities, we're going to talk about that, will yield higher returns and vice versa. If you go for investment with lesser risk, you will also get the higher return. Now, you cannot expect higher returns from securities with lesser risk. I hope you agree with me on this. So, as an investor, always try to balance the risk reward. That's where, asset allocation plays a pivotal role. In my previous videos, also, I have talked about asset allocation. I've talked about balancing. I've talked about don't put all your money into equities and all that. So that is where, asset allocation comes very crucial. It becomes very crucial to balance your risk reward. And as an investor, I would like to tell you, whatever might be your age, you might have heard about that. Okay, Amit, I'm young, I can take more risk. Okay, you can take more risk. You should take more risk. But at that same point of time, you should also try to balance your risk by going for those products which comes with a lower underlying risk. What are the products and everything? Let's talk about that. So, when we talk about investing options, you have basically four options. Number one is equity like shares. Number two is a debt. So, you can invest in bonds of any company, you can invest in debentures of some company, or I would say that you can put fixed deposits with bank, right? Fixed deposits and all this. Typically, these are fixed interest bearing securities. You can invest in real estate, and fourth is you can invest in metals. These are four broad investment classes that we can have: equity, debt, real estate, and metals. Now, each of this asset class has its own risk reward, has its own characteristics, and let's try to understand that in this particular video. So when we talk about equity, it's a high risk product. Equity comes with a high risk. You got to accept it. Like equity markets can go up fast, markets can crash also faster in the times of recessions and all that. So doesn't primarily generate fixed stream of revenue. Unlike debt securities, like if you've invested in a bond of company, you will get the fixed amount of interest at a fixed date at a stipulated period. Equity generally doesn't generate fixed stream of revenue. Uh, the source of cash flow, I'm not saying revenue, the source of cash flow from equity investment is dividend, but dividends are very, 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 very small proportion of return as far as an equity investment is concerned. Equity investments generally give return in the form of value appreciation and not in the form of cash inflows. So mainly focus on the value appreciation and enjoys a good liquidity. Here the best part is the liquidity is good. Like say for example, if you've got 100 shares of Reliance worth, for example, 1,20,000 rupees. If you need that money, you can go to your broker's terminal, just put the sell button, press the sell button, hit the sell button. Your broker will sell it immediately. There is a good liquidity. You can sell it off immediately. In India, there is a T+1 settlement cycle. So next day you will have your money in your hand. You can withdraw it from broker's account. And these days, many brokers give you immediate withdrawal facility as well. So there is a liquidity. You don't have to worry. You never get stuck like, oh my God, I'm stuck. Now what will happen to me? It is not going to happen. Second instrument is a debt, mainly focused on fixed income. So if you're someone who is looking for a regular cash inflow, this is a type of asset for you. If you're looking for the regular cash inflow, this is the asset class for you. It's a less risky product and obviously generate less returns. As I've been telling that there is a concept of risk reward. It always goes hands in hand. Equity carries a higher risk. Equity even carries a risk of you carry a risk of losing your whole capital in equity. Let me be honest. But along with that, let me also tell you that it generates super wealth for you if you do it in the right way. And that's what we're going to focus in this investing mastery series in the later videos. Bank FDs, corporate bonds are primary options. And again, it enjoys good liquidity. Like if you want to sell the bond, there is active market. If you want to liquidate your FDs, if you want to, if you want money from the FDs, these days, with the advanced technology, every bank gives you net banking facility. And if you hit the liquidate button inside your net banking, you get your money in your saving account or current account the very next moment, right? So again, it enjoys a good liquidity. Now, when it comes to real estate, unlike previous two asset classes, this is very liquid. This is what you got to be very, very careful about when you're investing into real estate. That if you need your money urgently at some point of time, you cannot sell it off immediately. You cannot realize the money immediately. Real estate is very liquid because of two reasons. It does not have a ready market price. Like if you want to sell your house or if you want to buy a house, there are negotiations take place. People ask, you might agree, you might disagree. If you agree, there is a loan. People generally take property on loan. So if your buyer has to take the loan from bank, again there's going to be legal proceedings and all that, and it is an illiquid asset. Understand that. Mainly return again comes from the value appreciation. Yeah, you might tell me that, Amit, in real estate we do get rents if you bought a commercial property or if you bought a residential property. If you bought plots and all that, land generally don't get any rent unless it has been rented out for some purpose. But again here, the rent generally doesn't beat FDs and bond interest. That is what I have observed. I may be wrong on that. Like generally, the kind of return that rent generates is around 4 to 6%. It depending upon the kind of asset that you have and kind of area in which you purchase your property. But again, I want to tell you that when you are going for the real estate, you got to be very sure that The rental income that you will get will never beat FD or bond interest. Now, why am I telling you this? Because if you're buying a real estate and thinking that you will generate a good return from the rent, please don't do that. In real estate, the original return will come only and only if the value of your property appreciates. And my dear, here I want to tell you, if you are buying your property into already a developed area, there are lesser chances of value appreciation. There are very little chances of value appreciation. Like, I belong from Ahmedabad. So, if you're buying your property into the possessed area of Ahmedabad, like I live in Bodakdev, Vastrapur, or CG Road, we have got a CG Road. Like, if you belong to Mumbai, you generally don't get capital appreciation if you buy a property in South Bombay. If you buy property in Charni Road, Grant Road, in Nariman Point, you don't get capital appreciation because the value of property is literally so high, so skyrocketing, the room for appreciation is very, very less. And this is a very vital concept that you need to understand. Is it powerful? Give me powerful in the chat box. Is what I'm teaching you is powerful? Just type in powerful. I have seen many people doing this mistake. They have some amount of money, they take the loan for balance, they invest in a real estate, and they think that the rent they are getting, oh my god, we are getting a monthly fixed income, we are smart. No, my dear, bullshit. The interest you are paying, that is also net met by the real estate. In terms of value, you might feel like, okay, I'm paying an EMI of 50,000, I'm getting a rent of 50,000. But my dear, when you're getting a rent of 50,000, the whole capital has not been funded by bank. Part of that capital has been funded by you as well. So you got to consider that as well. Fair enough? So that's a very powerful concept. And last is metals. It generally includes precious metals like gold and silver. In India, people invest in metals mainly for social needs rather than for investing. Generally, in India, people buy gold and silver because they have to give to their children when they get married and all that. But my dear, I can tell you, gold and silvers provide very good investment opportunities. And these days, many products are available like gold ETFs, gold bonds are available. You can invest in that. You can enjoy liquidity. You can enjoy safety. Like if you buy the physical gold, you have to worry about the safety of it. It can get stolen. There may be theft about it. But when you go with all this, you can enjoy uh, safety, security, and also at the same point of time, this gold ETFs and gold bonds are linked to the value of gold, so you can take the benefit of that. So these are the different classes of asset that we have, and these are the different risk rewards that we can talk about. I hope you loved the video. Please do let me know in the chat box. Do let me know in the comment box what was your biggest learning from this video. I'm waiting for your comments and see you in the next video. Bye bye.